Hello everyone. In this session, I'm going to talk about different ways in which we can perform a portfolio optimization. So let's say I have 10 to 15 different kinds of assets to invest. Again, the number is just an example. So I have some number of assets to invest and I really want to make out how much to invest in which asset and catering to different kinds of objectives. So here I am more and more focused only in long only kind of investments. So there is no shorting in these methods that I am going to talk about. We are not having any kind of option to short. These are long only kind of optimization. So I want to buy and I have various objectives. So one of my objective could be it could be a completely minimum variance altogether. The risk of the portfolio should be the least possible. I want to choose that kind of an investment. Or in some cases, I want the investment to my portfolio to be more and most diversified. To whatever extent possible, I want to diversify across the various asset classes or across the various investment categories that I have. Now, this is where I want to choose my objective. Here we are talking about a few such kind of objectives, right? So I would be looking at few objectives like this. I want my variance to be the least possible. I want the most diversified kind of a portfolio. Here, as I said, one, I'm not bringing in the shorting scenario at all. So so the weightages will always be positive because I'm only buying. There is no question of selling. So when the shorting is there, then there is a possibility that the weights could be negative and some weights could be more than 100% as well. Whereas because here we have completely long positions only, it is very much possible that the sum of all the weights will be equal to 1 and each of the weights individually will be a positive number only. Some of the things. So only those kind of portfolios we are looking at and just seeing what we are covering in this particular session. I'm looking at the most common portfolios that we can create. As I said, one, we have the minimum variance kind of a portfolio or most diversified kind of a portfolio. Sometimes I am more and more bothered about the tails, right? So I will look at only the tails related relationship and based on that I will try to position my portfolio. Or in some cases, we even have situations where there are drawdown constraints. Especially people don't want to lose more than some specific amount. Their portfolio value cannot drop cannot drop beyond a certain value. So those are the kind of drawdown constraints that are there. So if I have to consider those drawdown constraints and then do the allocation, then what is the kind of the best possible allocation that I can do towards the various asset classes? And how do I really measure the various diversification? How diversified is my portfolio? Or how concentrated is my portfolio? So we have a few measures which talk about the diversification aspect of the portfolio. So once we build a few common portfolios, Then we will look at how do we evaluate the diversification aspect of that portfolio by looking at the diversification measures. Then this is a very important point, the marginal contribution to risk. So we are talking about how much each portfolio, each asset, let's say I'm talking about 10 to 15 assets. So first asset, okay, what is it contributing to the overall risk? Now, the second one alone in isolation, how much it is contributing to the overall portfolio risk. Similarly, the 11th one, how much it is contributing to the overall portfolio risk. So we are talking about the marginal contributions to the risk in each of the security cases. And in case, so it might very well be possible that some securities will contribute more to the overall risk, some of them will contribute less to the overall risk. Now, if I really want to create that kind of a portfolio where all the assets contribute exactly equally, so which means if I have 10 assets, each asset's contribution is exactly 10% to the overall risk, which means the total is exactly equal to 100% and each of them have 10% each. So in that case, what is the kind of portfolio mix that I'm going to get? I'm going to understand that as well. And finally, as I've said, different kinds of drawdown constraints are there. So if I really want to create a portfolio with different kinds of drawdown constraint, how would I really work that out? So that's the major thing that we are discussing as a part of this session. For this, the data set that I am considering is the monthly different index values like automobile index, the banking index, right? The IT index, the healthcare index, different kinds of index values on the monthly basis on the Bombay Stock Exchange. So this is what is the data which I have taken right from 2007 January to 2016 December. And this information is typically used for building all these portfolios. So I want to make sure what should be the proportion of allocation I have to do in case I want one of those investment objectives to be met. So that's the typical thing that we are going to look at. We will execute this entire thing using R itself. So let me get the data into R first of all. Right, this is the blank thing. So the code of R, I have actually taken it in a notepad so that we really won't end up just typing out, spending time just typing out the stuff. So I'll explain the line by line. So the first thing that I'm getting the index.csv file that I have in this particular folder of my system. I'm reading it and I am assigning it to a variable called index. So this is what is my index. Now obviously once the data is got, we know that we can do a few basic checks. One, I can look at the dimension of this index. So there are 120 rows, which is 12 months, 10 years data, and I have 12 columns, which means there are 12 different one column is a date column. So there are 11 columns indicating 11 different sectors altogether. So I really want to have my portfolio diversified across these 11 sectors. Then looking at the first few entries of this index where I could do a head of index. The first column is saying month, telecom, realty, PSU, oil and gas sector, IT, health, finance sector, FMCG, fast moving consumer goods sector, energy sector, banking sector and the automobile sector. So these are those sectoral indices right from 1st January 2007 or right from January 2007 till December 2016. Now, I can also understand the structure of this to understand the types of each one of them. So overall, it's a data frame containing 120 observations and 12 variables. Now, all these telecom, reality, PSU, they are all numbers and these are the values. But month is actually being treated as a factor variable. It's not treated as a date variable. That's the biggest drawback. Month is treated as a factor variable. It's not treated as a date variable. So the first thing is I better convert that factor into a date. Right? So this is something that we have already done. This step also we have done. So now comes the conversion process into a date. Now we know the code, but just try to understand. So initially the index dollar month is a factor. So first I am converting that factor into a character by doing as dot character. So this factor will become a character now. Now the character I am converting it into a date by giving as dot date. So as dot date, and this is a character date, and I am giving a format in which this character needs to be understood. First part is the day, so that's where I am giving percentage D, then hyphen, hyphen. The second part is the month, giving it as percentage M, and then this is a 4-digit year, that's where I am giving it as hyphen percentage capital Y. So this step ensures that it will look out for this format in my data, percentage D, which is this one, hyphen percentage M, hyphen percentage capital Y. So wherever it is finding this kind of a format, immediately it would convert them into a date format. And just to give you, just to make you remind you, the valid date format in R is something like this, which is YYYY hyphen MM hyphen DD. So this is the only valid date format in R. Anything else you give, it would be treating it as a factor or a character. So if it has treated it as a factor, better convert it into a character first, and the character convert it into a date by giving the format of the character. So that's how we are going ahead with the conversion of this into a valid date format. So if required, now we can very well look at the structure of this index, which now it shows that the month is a date, and this is how the format is coming, YYYY hyphen MM hyphen DD. So that is how the typical date format is going to be. Now with this, let me come to this, the most common portfolios. So we were talking about three major portfolios here. Let me tell you here, we are not considering the short positions at all in the portfolio, only long positions, and we do not have any kind of expected returns. So even those are treated separately, they are not there as a part of this particular portfolio. Let me tell you, these the current session does not consider these two aspects of the portfolio. I having short positions and I having some kind of an expectations on the return. So here we are more and more looking at the variance based kind or correlation based kind of portfolio creations itself. So going into that aspect, if I look at the first one, which is the global minimum variance portfolio, I will be executing that from a package called Frappo. Here we are to a large extent in this session, we are using this Frappo package itself. So let me load the package. So I want to use that package. So I'm loading that package. If you have not installed it, better install it. And after that, load that package. Okay. Then get the prices data. We have already got here the prices for me are the various index values. So let me quickly look at the head of that index to confirm the stuff. So this is how my data is present, month, and these are the various sectors. So generally, it's better that I convert it. This is a time series kind of a data, right? So better convert the data into a time series data to start with. And after that, it's better that we progress further. So how do I convert it into a time series data? I require the time series package to be installed. Obviously, when I loaded this Frapo, time series also got loaded. So I can very well search for this function called time series, right? Which says it's a function to generate and modify the time series objects. So I would like to look at that. So time series wherein I have to give a data and then I also need to give a character vector. So the data is those values which are representing the time series. So right from here till here, all these columns are representing the time series data. This column is not representing time series. It's actually an indicator for the time. So this is where I would not consider this as a part of time series. Only these things I want to consider as a part of time series. So this is where I am doing a modification, and at the same time I have to give character vector. Character vector is a character vector of dates and times, or any object which can be coerced into a time date object. So it should be a kind of a vector which is a representative of the time related stuff. So I will require these two things as a part of the input, and all others look like the optional kind of stuff. So I don't need to bother too much about the others. I require these two. What I'll do is index, I'll treat it as time series of these two things. Now first let me give data is nothing but it's a subset of index which requires all the rows and all the columns except the first column. So that I'll take all telecom, reality, all those things which are different time series. So that is what I'll take it as a data. And as a part of character vector, I will take that particular vector which is index $month. So this is what I'm taking, converting the whole data into a time series, and I'm assigning the same back to the same index variable itself. So that way, now if you are looking at the class of index, it's a time series class now. It's no more a data frame. Even if you are looking at the structure of index, you'll get a different structure. It's a time series object containing 120 rows and 11 columns. So which means this column is no more a column now, it's more of an identifier. So these are the column names, these are the row names. So they became the row names, each of the time periods. So starting from 1st Jan 2007 to 1st December 2016, the format is something like this, which is a date format, right? So this is what is the details of it. Even if you want, if you look at the head of index now you don't see the heading for this time related variable. All others are having the heading. So that's the first step. We have converted the data into a time series. So this is something we have done right now. And after that we have looked at the structure. So this is the data with which I am ready now. It's a time series data of the index values. Now with this I am ready to build my portfolio. So if I look at it now, this step is done. I have taken it as a kind of a time series format as well. from a regular data frame, I have made it as a time series object. Now, I can either compute the discrete returns or the continuous returns using the return series function of the Praco package. Now, if you look at it, I have used the return series function. Let me explain that to you. Let me copy this function to compute the index returns. So if you see here, it's a return series function. So the first thing that I am giving is the prices. So the prices are there or values are there as a part of index. Based on them, I want to compute the returns for a series of values. So that's where I'm using return series. In method wise, I can use either a continuous or a discrete. We all know if I want to find out continuous returns, right, continuous returns, the formula that is typically considered is log of P2 by P1. Whereas if I want discrete returns based on two prices, P2 minus P1 by P1. So this is what is the way based on two prices the discrete return would be computed. This is the way in which the continuous returns would be computed. So what is that I am saying? First I am giving, so here in this case, if I have to take this telecoms, these two as example, logarithm of 1648 by 1685 will give my continuous return. 1648 minus 1685 divided by 1685 will give me the discrete return. So either way I can give whether it's a continuous return or a discrete return. Right now I have given a continuous return to be computed, and I can give an option of percentage equal to true. So percentage equal to true means it will be computed as into 100. Right? That is what means meant by percentage equal to true. But if I said percentage equal to false, it would be expressed in a decimal form. So either of the two will lead to the same solution. But again, it's a personal choice. So if I said percentage equal to true, I can very well convert it into multiplication by 100 and it would be converted into a percentage form. Trim equal to true is a very important thing in this context because I said log P2 by P1, right? That would be the return as on 2007 February. But how do I compute the return for 2007 January? I don't have, if I take this as P2, I don't have a P1, which is the previous period price. So because I cannot compute this one at all, the whole set will be trimmed. Means if I have 120 rows of data, now because of this trimming, this row will be lost and I'll have only 119 rows of data. But if I set trim equal to false, this whole thing will be shown as NAs, which look pretty odd and I have to handle those NAs separately. So that's the reason I am going with computing the index returns in this manner. I am going with the continuous return. So these are the continuous index return. If required, I can quickly check what are the values that are coming out of the index returns by doing a head. So these are the returns. So first day it is minus 2.26%. I mean for the first month. Then for the second month it looks like an increase which is like 7.32%. There is a 7.32% increase in the second month. And you see here the dates wise it starts from February, it does not start from January. Then in the next month again there is an 8.86% increase, but the next month again it's only a 4% increase and so on. Whereas the realty sector, the first month itself there is a fall by 25%. From 7,200 it went to 5,600. So there is a fall by 25%. So you could see that for different sectors these are the different returns measured on a continuous basis. But if I want to do the same on a discrete basis, I could have used the same function. So there are two ways. I'll call, let's say, index return D, and instead of continuous, I'll change it to discrete, all else remaining the same. So now if you look at the head of index ret D, which is where you have computed the discrete return, you see the numbers are slightly different. It is minus 2.23%, slightly higher than this. All discrete returns 7.6%, 9.26%, 4.81%. You see the discrete is always higher compared to that of the corresponding continuous return. Wherever you are seeing across, so that's again theoretical aspect, you will always find that the discrete return is higher than the continuous return, and the gap will be much bigger based on the time interval. So because this is a monthly data, it might so happen that there is a big difference between the discrete and the continuous. But if we are considering daily data or something like that, the difference between the discrete and the continuous is very marginal. And we have a way in which we can convert from discrete to continuous or continuous to discrete as well. We can use a function called return convert, and this return convert is helping me in terms of converting from discrete to continuous or continuous to discrete. If you look at this here, return convert, so I have to take the return. So I am taking, let's say, the continuous return, which is index ret. This is my continuous return. Then I am using a parameter called convdir. So conversion directory kind of stuff. So I am specifying continuous to discrete. So I am giving continuous as an input, and I want that continuous to be converted to discrete. If I am giving discrete as input, I'll say here disc to cont. So in that way I'll convert the discrete into a continuous and percentage equal to true. So even if I am doing this one, right, and I look at the head of this as well, I should see that whatever I have got through direct discrete and even through this should give me the same result. So let me see this. So if I am taking, otherwise first let me get this, then after take it into the same variable index ret D, and I'll take the head again with index ret D to really compare whether the values are more or less the same or not. You could see here we have computed the original index ret D using this return series function, and then we have computed the same using the conversion from continuous to discrete. The values are more or less the same across. So one thing is I have to decide whether I am working with the continuous returns or the discrete returns. If I have one return, I can very well convert it into other, because the mathematics simply permits the conversion quite comfortably from one form to the other. Now comes my portfolios. So basically, I have converted the continuous returns to discrete. So we'll work with the continuous returns itself for all our portfolio building process. So even if you want to work with your discrete returns, now you have the data to work with them as well. So which ones you want to use, you can very well choose. But now, based on the returns data, we will first create the global minimum variance portfolio, and for that I'll use a function called PGMV. So just trying to understand what this PGMV is doing for us. It's a solution of the global minimum variance portfolio. So this function is giving me the global minimum variance portfolio for a long only position. As I said, we are not considering the short positions here. and we do not specify what is our expected return as well. So because of those two things, I am not considering them at all. I'm getting a global minimum variance portfolio. So let me get this code. I'll explain this. So I could see I'm getting a portfolio which is a global minimum variance GMV based on the index returns, which are the continuous returns where the percentages are true. So I'm getting my output in form of percentages. So this will give me how much should I allocate. So what this gives me is the weights, right? What this gives me is the weights that I have to assign to each of the 11 different kinds of sectors, so that the overall variance of the portfolio is the minimum most, right? And the way it computes that is based on the variance covariance matrix of the asset returns. So it looks at the variance as well as the covariance between the various asset returns, and based on that it tries to find out the allocation across the various sectors or the asset classes, so that the overall variance of the portfolio is the minimum most. So in this case, this is what we are working out to create a portfolio which is having a global minimum variance. So there are some of the things that are being done. It's a kind of an iteration process, as we could see, right? So it is working out across the iterations. The objective function is being looked at, and based on that the steps are continued where the overall objective function value is being looked at across, and finally the error needs to be as minimal as possible. So once it has come to a kind of a consensus on the objective function, this is where and the error is minimal, that is where it has gone ahead in terms of finding the optimal solution. Now in this process I really want to see what is the kind of variance that has come out, right? So this is my portfolio, which is a global minimum variance portfolio. Now if you see here in this portfolio, global minimum variance portfolio, I can type in P1 to see what it contains. I could see that it is telling me that I should invest 0.76% of my total money. So let's say if I am going ahead with 100,000, right? If this is the amount I wanted to invest, going with quick rounding off, probably I could have done the rounding of the P1 to 2 digits, right? Or probably these are the weights. So what I'll do is round weights of P1 to 2 digits. I will do that. So let's say I have 100,000 with me. Then it says 16.05% I allot to IT. So out of the total money that I am investing, I am allotting 16.05%, which is 16,050 bucks. I am investing in the IT sector. Then in healthcare, I am investing approximately 18,240. So this is the amount I want to invest in the healthcare. Similarly, 0.77%, which is in telecom, I'm investing only around 770 bucks. Reality nothing, PSU nothing, oil and gas nothing, finance nothing, but FMCG constitutes very heavily in my portfolio. 62,240 bucks I'm investing in FMCG itself if my overall variance has to be minimum most. And energy wise, I'm investing around 2,710. So that's how my overall thing is going out to 100,000 as per this portfolio allocation method. So majority is going into FMCG, then into health and IT, whereas and very minute into energy and telecom, whereas in 6 sectors I'm not investing at all. So that is the kind of solution that the system has provided to me with the objective function that I wanted a global minimum variance portfolio. The variance has to be the minimum most thing altogether. And if I look at the structure of P1, it will give me what all things that it is doing as a part of the output. I could see here these are the weights that it has given to all of them. That's something which we have already discussed. Then I could see that the various the mechanism that it has typically followed across for executing the same, right? It has gone ahead in terms of minimizing the overall variance of the portfolio, and I could see here the various steps that have gone ahead. You could see that there are 16 methods that have been tried and 2 of them are possibly relevant. And these are the various steps that have gone ahead in terms of the computation process altogether. It has taken 11 iterations to finally give me a solution. And these are the weights. And if I really want to use those weights for any specific purpose at a later point, I can very well extract those weights and I can very well use them. So basically, as I said, you can use weights of P1 wherein you can very well refer to them for any kind of further purposes as such. Right, so that's the typical way we are creating a portfolio and we are using those numbers coming out of the portfolio. So this is the long only kind of a portfolio for me. So that is what up to here. It has used the variance covariance matrix. So basically if I do a covariance of index red, that is where I get probably the reality sector is looking very risky. The variance is much higher. In the variance covariance matrix, the diagonal indicates the variance and all others talk about pairwise covariance between the sectors. So it has asked me to invest heavily in FMCG. The reason being, you could see FMCG is one of the least risky kind of sectors altogether. And probably if you are comparing FMCG with health or even with IT, I could see that the variances are covariances are much lesser. And even in isolation also, IT sector is having a variance of 56, much lesser than majority of the sectors. Health is having only 37, again lesser than majority of the sectors. And that's one more reason the solution, if I have to minimize the overall variance of the portfolio, it is suggested that I invest in this kind of a combination. Right, and if I really want what is the overall variance of this particular portfolio, I can very well compute the transpose of these weights right. I can very well take weights of P1, do a matrix multiplication of the covariance of the index returns. So multiply this with the covariance of the index returns and whatever is coming out, again do a matrix multiplication of that with the transpose of the weights, of P1. So this is giving me non-conformable argument. So this is a 1 by 11, this is 11 by 11. 1 by 11 and transpose of this should give me 11 by 1. So first let me do only up to this. Right, so this is becoming 1 by 11 kind of stuff. So this number I multiply it with the transpose of this. So basically let me take this number entirely in brackets and then do a matrix multiplication of transpose of this number. I'm doing a transpose of this number, gives me that 5, 6, 7, 8, 9, 10, 11. Or probably let me directly take the numbers here. I'll take these numbers. Let me call these. Otherwise, let me do one thing. Let me call this by a variable A, these weights. Right? Let me call these weights by variable A. So if you look at the dimensions of A, it is 1 row and 11 columns. Then I'll take the transpose of the weights of P1, which is going to work out like the transpose is, okay, the weights of P1, if you look at the dimension of the weights of P1, if I look at the dimension of the weights of P1, that's not, so the weights of P1 is not coming out. Okay, then we can very well talk about each individual multiplied. So I can very well talk about the summation of weights of P1 multiplied by A. If I take this, it's working out to this much. So that's the overall variance. I am reducing the overall variance of the portfolio. So this is the variance of this portfolio. I take the square root of this, which is going to give me the standard deviation of this entire portfolio. So the standard deviation of this entire portfolio is going to be this much. This is the variance, and this is how I can reduce the variance altogether. The overall reduction in the variance is coming out, the overall reduction in the, it's a global minimum variance portfolio if I go with these kind of combination. So that is what is the overall step. Now, the second one that I am going to talk about is the most diversified portfolio, for which we would be using a function called PMD. All is the same as the global minimum variance portfolio itself. The allotment is exactly same as global minimum variance itself, but instead of using the variance covariance matrix for the allocation, here it will use the correlation matrix for the allocation across the various classes. So when it is using the correlation matrix, the individual standard deviations are not taken as inputs here. So this is where there is a possibility of the most diversified portfolio coming up. So that is what, if I want to look at it, the PMD, everything is exactly the same. I'm giving the returns, percentage is true, and the other characters. So probably I can directly copy this piece of code and I can assign it to P2. P2 is a portfolio which is the most diversified kind of a portfolio for me. I'm giving the index returns, which are the continuous returns which we have computed. The percentage is true, means the values are in the percentage form. So based on this, I am getting my P2, which took around 9 iterations altogether. Looking at P2, it talks about these are the weights. So here you see, if I am going with most diversified, I am reducing the allocation across one single sector. So telecom, it says I can invest 15,543. In the telecom, instead of 770, this model says you invest 15,543. Still it says nothing to reality, but PSU it has given 5,535, which our earlier model did not give. 5,535 is being given to PSU. Oil and gas, very minute. IT around 30,469 is going towards IT sector as a part of this diversification. Healthcare only 2,433, because here it's not considering the individual variances at all. FMCG has gone with 35,000, energy went with 6,300, and banking went with 4,200 out of that 100,000 kind of the total investment. So this is what is the overall diversification part, right? And if I don't think we can plot these graphs, right? So I cannot talk about plotting these, but I can very well look at the structure of P2. Again, as we see, it gives me all these various intermediate computations for each of these sectors, and finally it also gives me out of the overall weights are being specified here, and this is the most diversified kind of a portfolio. So if I typically go ahead in terms of computing the overall variance, etc., in the way that we have used earlier, probably the variance could be slightly higher than what came in the earlier case. But if you look at the variance now, it could be slightly higher than the 400 and standard deviation of 465 that we got earlier. This time it could be slightly higher. If you really want to check that out, we can first take this. We'll take A, which is the weights multiplied. So I am taking A, which is weights multiplied by the covariance of the index returns. So A is working out to be this much, and I have taken the summation of the weights of P2 multiplied by A. So based on this, I am able to see that this is 267,000, and going with the square root, this number is actually giving me 517, the standard deviation wise, whereas earlier the standard deviation was only 465. So which is an indicator that here the overall variance is higher, but this is much more diversified portfolio compared to the earlier one. So if I choose the weights in this manner, my portfolio becomes much more diversified compared to the earlier portfolio. So this is the process. You could see that the weights are computed based on the correlation matrix. I'm not going into more and more details. I'm just giving you the basic insights into each of the different measures. So the weights are finally computed by doing the rescaling of the optimal solution with the standard deviation of the asset. So whatever the solutions that have come out, we have rescaled it with the standard deviation of the assets and normalized it in such a way that the overall sum of the weights is coming out to 1. So having an allocation of this kind is giving me the most diversified portfolio, but this is not necessarily the one that is having the least risk. It is slightly more riskier than the global minimum variance portfolio, but it is one of the most diversified kind of the portfolios. So that is one more solution that I can look at. Then we have another version of this portfolio which is called as minimum tail dependent portfolio. Here we are not looking at correlations or covariances for the entire data. We are generally looking at the tail. Right here the focus is only the tail data. So the correlations are typically computed only for the tail, and based on that the allocations are typically done. The intention here is what is the kind of relationship that is existing between the sectors in the extreme cases. In the normal cases we are not looking at it, only in the extreme cases how these variables are correlated, that is what is driving the overall model. And for that we are using a function called PMTD, but that is primarily computed. The variance covariance matrix here which we had in the earlier case, we are not taking that. We will be going with pairwise tail dependence between the coefficients. So we are trying to find out the pairwise tail dependence coefficient. And the tail for us, if I specify what is the tail, how many numbers, how many values out of the total constitutes the tail. So based on that the correlations would be computed. But otherwise the default is the square root of the number of observations. So here we have approximately 120 observations. So approximately 11 observations would be taken as a measure of tail, and the covariance, the correlation between those worst 11 would be typically be considered for patching up what is the level of the correlation that is existing between them. And that is how the tail dependence coefficient is coming into picture. Only the worst few values are typically looked at. And within that, the coefficient, they can be estimated in two ways. One, they can be measured through empirical tail copula, where I would be giving a method called EMPTC, right? Or it could be based on stable tail dependence function, where I am giving the method as EVT. So extreme value based theory. So we are using either a stable tail dependence function or it could be an empirical tail copula kind of a method. So these two methods are used to first compute the tail dependence coefficients, and based on the tail dependence coefficients my portfolio allocation is happening. So let me just try to see the tail dependence coefficients in both the cases. So if you look at this statement TDC, let's look at this statement first, then I'll create the portfolio. So it is simply saying I take the index returns. Method wise I'll use the empirical tail copula method, and I am taking only the lower triangular matrix. Of course in correlation either I can take lower or upper, does not matter. So I could see here, this is how the empirical tail copula method is giving the relationships, right? I could see that between the reality and telecom, the correlation is 0.4. Whereas if I simply look at the correlation, the regular correlation between the index returns, these are the numbers. So it shows that the correlation between reality and telecom is around 0.66, or probably reality and PSU is 0.86. Whereas if I am going with the empirical tail cupola approach, it looks like the correlation between reality and PSU is hardly to the extent of 0.5. Here it looks the highest. Energy and oil and gas, the correlation looks out to be 0.8. Even if you look at it here, energy and oil and gas, probably the correlation is much higher to the extent of 0.99. So this is only looking at the tails, whereas this is looking at the entire data. Even here the number is much higher between finance and banking. Finance and banking, even the correlation values are also looking much higher. So this is based on empirical TC kind of a method. But similarly, if I go with the EVT kind of a standard function, in this case, probably there's not too much of a difference across the. So here, whether I'm going with EVT or EDC, because the sample size is much smaller, whether I'm going with EVC or MPTC or EVT kind of method, both of them are giving me a similar value for the tail. So instead of using these numbers, right, most diversified portfolio is doing the allocations based on these correlations. Whereas when I'm going with the minimum tail dependence kind of a portfolio, which uses the PMTD function, it goes more with these correlations rather than these. So that is where again the allocations could be slightly different. So if I want to look at the allocations in this case, I'm taking, because here P3 and P4 will be the same, because whether I am using the empirical tail cupola method to find out the tail dependence coefficients, or I am using the extreme value theory kind of a method, both of them are resulting in the same tail dependence coefficient. So that's where it hardly matters whether my portfolio is based on MPTC or it's based on EVT. So in this case, for this example specifically, my P3 and P4 should be more or less the same. So input wise, I am giving to the minimum tail dependence portfolio, I am giving the index returns. The method I am saying it is empirical tail cupola method. I could replace it with EVT as well in percentage terms. So again, it took around 9 iterations for the overall accomplishment. And when I'm checking my P3, this is giving again a different proportion. It says 11.12 in telecom sector. Right, so the telecom, it has given 11.12. Still it is saying 0 in reality. PSU, it has given some 3.6%, oil and gas 12%, IT 24, healthcare 11, FMCG only 17, in finance 0.95, banking 13, and auto 3. Now going with this, again if I have to see what is the overall variance of the portfolio going with this kind of a mechanism, overall variance of the portfolio could still be higher than that 467. Overall standard deviation could be higher than 467, which we got through the global minimum variance portfolio. So if I look at the sum of A multiplied with weights of P3, so this has gone up to 323,000, and the square root of this has gone much higher. So it's even more, the risk of this is even more higher compared to the most diversified portfolio as well. But yes, the tail wise, I'm relying much lesser on the tail correlation. I'm trying to avoid the tail correlations to the minimum by going ahead with this kind of an investment. So that's how we can look at different kinds of portfolios and the solutions associated with different kinds of portfolios. How much should I invest in each of the various assets or sectors, so that either my overall variance goes down, or so that I can create a globally most diversified kind of a portfolio, or the overall tail dependence becomes much minimum most. So three common kinds of portfolios which we can suggest to the clients. They have different levels of risk, but again the objectives are different in each of the three cases, right? So once we have created these three different kinds of portfolios, now comes the assessment of a few important things associated with the portfolios. So let's look at a few computations on these three portfolios P1, P2, P3, so that we can do a better assessment of them. Right? Now, we'll look at the diversification measures on the portfolio that is created. So here I want to talk about three important measures. One, the diversification ratio. Then we have a concentration ratio, and we will look at the volatility weighted average correlation. Formulas wise, these are the formulas, but instead of explaining them in mathematics, if I am looking at a simple explanation of those formulas, I am taking the ratio of standard deviation of a weighted portfolio, which means I am taking the weights multiplied by the individual standard deviations. So for all the three portfolios P1, P2, P3 that we have created, we got their individual weights, weights of P1, weights of P2, weights of P3 across each one of them. So individual weights we are multiplying with their corresponding standard deviation. So that's the numerator, and the denominator comes out to be the overall standard deviation of the portfolio. So I am taking the standard deviation of the portfolio after considering the correlations between the assets, and the numerator is talking about simply the simple weighted average of the portfolio of the individual standard deviations. Now what we see is, if the diversification is much better, the denominator should become much lesser, because the overall portfolio standard deviation should go lesser than the individual weighted standard deviation, which means the overall ratio should be higher. The higher is the ratio, the higher is the degree of diversification. So obviously for the most diversified portfolio, I should get a very high value of the ratio, whereas for the other two it should be lesser. And I am looking at the using a function called DR, which talks about the diversification ratio of the portfolio. Now let me try working out with all the three. I am having something called DR, where I am taking the weights of P1 along with the covariance. I have to give these two as the inputs. If you look at this, in the DR, I am taking the first input as the weights. Weights of P1 is one input that I am considering, along with the covariance of the index returns. So for whatever is the model, this covariance of the index returns will be the same as long as my data is the same, whereas the weights would differ. So let me look at the diversification ratio in each of these cases. So in the first case, the diversification ratio is 1.24. So if it is 1, it means that there is hardly any kind of diversification. There is no diversification benefit coming through this portfolio. But the more and more I am moving above 1, the better is the kind of a diversification benefit I am getting through this particular portfolio. Let me try with the second model, which is the most diversified kind of a portfolio. So this is giving me 1.36, means this is much more diversified compared to my global minimum variance portfolio. The straightforward thing out here, this is much more diversified compared to my global minimum variance portfolio. And if I'm looking at minimum tail dependence portfolio, for that, if I'm looking at the diversification ratio, it's 1.32, somewhat better than the global minimum variance portfolio, but it's not that more than compared with the most diversified. Obviously, the most diversified should have the highest diversification ratio as well. So this is one thing which we will use for evaluating the diversification of the portfolio. Then the other thing that we are talking of is the concentration ratio. So we are measuring the portfolio's concentration out here. If you look at the denominator, it is W1 sigma 1 squared. So it goes like this: W1 sigma 1 squared plus W2 sigma 2 squared plus so on Wn sigma n squared. And the denominator is coming out as overall squared, W1 sigma 1 plus W2 sigma 2 plus Wn sigma n squared. So if you see here, if at all the concentration is much higher, the numerator is talking about the squares, individual squares, whereas the denominator is talking about the squares along with the interaction terms. So if the interaction terms are much more in number, the numerator will be very small compared to the denominator. So the ratio could be very small, it can be very close to 0. So if the denominator is more like that, it indicates that my portfolio, if the overall ratio is very close to 0, it indicates that my portfolio is very much diversified. But if I'm having only one asset, so even the numerator is W1 sigma 1 squared, denominator is also W1 sigma 1 squared. So the overall ratio is close to 100%. So if it is only one single asset, it means it is more and more concentrated on one single asset class itself. But if the value is much lesser, closer towards 0, that indicates very high diversification as a part of the portfolio. So that's again another diversification measure that we can talk of. And generally people use it to determine the effect of new asset on the portfolio diversification. If I am adding one more asset, to what extent the diversification can overall come up. So this is the formula. We are taking the sum of squares of the concentrations of the individual assets. The lower the ratio, the concentration is much lesser, which we'll talk about more and more diversified thing in the portfolio. So let me try computing the same by taking out the formula again from my code which I have copied out here. So I'm looking at the concentration ratio. Just like the way I have computed the diversification ratio, I am computing the concentration ratio from for all the three portfolios that I have created, P1, P2, P3. So here the concentration in case of P1, it's only 0.38, very close to 0. So it indicates some level of diversification. Whereas if I am looking at P2, P2 is having only 0.22, indicates much more diversification in terms of the portfolio compared to P1, right? Very close to 0 indicates more and more diversification. Very close to 1 indicates more and more concentration on a few asset classes, one or few asset classes. And in case of P3, the number is much more lesser, indicating that in case of P3, the concentration is almost not existing. But at the same time, the diversification ratio has not given the most diversified kind of stuff as well. So these are two measures of diversification. And then the third measure that I can very well look at is volatility weighted average correlation. If you look at the numerator, this part is the weight multiplied by the correlation divided by the sum of weights. So if I am talking about individual weights, their weights multiplied by the correlation between them. So if the correlation is much higher between each one of them, obviously this average correlation also would be much higher. Whereas if the overall numbers are much lesser, even the overall weighted average correlation is also much lesser. The weighted average correlation lesser and lesser indicates more and more diversification for the entire process. So now if I am going with again for each of the models, I can use this function called RHOW. And rho, basically here it is nothing but the weighted rho. That is where RHOW, rho weighted. Rho is a measure of correlation. Weighted, I am taking the for all the three. So I am taking the weights with respect to P1 and the covariance, based on which the average weighted average correlation is talking of 0.42 in this case. But when I am going with the P2, the diversified, most diversified portfolio, it's showing only 0.40. And when I am going with minimal tail dependence portfolio, the correlation, the number has gone to 0.48. So again, in the most diversified kind of a portfolio, I see that the weighted correlation has been the least. And as we all know, that method itself, the most diversified portfolio method itself, is purely based on the correlation as the input, not the variance covariance matrix, nor not even the tail dependence correlations between the variables. So that's the reason we have got the least possible weighted average, volatility weighted average correlation for the global minimum variance portfolio itself. And you could also check the relationship. The moment I am going ahead with these numbers, I can put this kind of relationship as well. The diversification ratio is nothing but 1 by square root of the weighted average correlation multiplied by 1 minus concentration ratio plus the concentration ratio. So this is going to give me the overall diversification ratio as well. So even that kind of a relationship can quite comfortably be tested once we have the values. Let me try for one of them. Right, let me try for P2. So I'll say 1 by square root of, if I look at the formula, the weighted average correlation multiplied by 1 minus concentration ratio. So I'll take it for P2. This is the weighted average, right? This is the weighted average correlation multiplied by 1 minus concentration ratio. 1 minus concentration ratio for P2 and plus I am taking the concentration ratio itself. The concentration ratio of P2 is going to be this, and overall I am taking the square root of it. So the number is 1.365, which is exactly same as the DR that we have got out here, the diversification ratio. So that's another way to really bring the linkage between these three measures of diversification on any specific portfolio, right? Now let's move on to the next point, where I am interested in looking at what is the marginal contribution to the overall portfolio risk. We have got the overall portfolio variance of this particular portfolio, where we have computed the variance of the total portfolio in each of the cases. So what I really want to see is out of this total variance of the portfolio, how much is being contributed by each of the individual sectors. And the same thing, out of the total standard deviation of the portfolio, how much is typically contributed by each of the individual sectors. That is what we are calling as the marginal contribution to risk. We'll be using the MRC function from Frapo package, but first let's understand the contribution, the conceptual part of it. So when I'm talking about the overall portfolio risk, we are measuring it as the overall standard deviation, not the variance. And when I'm using this function, or when my objective is to find out the marginal contribution to risk, each security's marginal contribution to the overall portfolio risk is what we have to compute. And the other way of putting the same is by what extent the portfolio's risk is going to change if I am bringing in a small change in the holding. If the portfolio's holding increases by 1%, what would be the impact on the overall portfolio risk? That is what we are calling as the marginal contribution to risk. Mathematically, if you see, this is what is the way we compute the overall variance of the portfolio, right? x1 squared, x2 squared, or probably x1 squared plus x1 squared plus x2 variance of 1, x2 squared variance of 2, 2x1 x2, the covariance between 1 and 2, and so on. So this is how we are getting the overall variance of the portfolio. When we are using the marginal contribution to the variance, I am taking the derivative of the variance with respect to each of the individual weights. So that way I am taking the variance of this portfolio, I am taking the derivative with respect to xi, giving me twice xj times cij as the covariant, the marginal contribution to the variance, which in other way is coming out as twice the correlation between the security and the portfolios. So overall security returns and the portfolio returns, I am taking the correlation and I am doubling it. That is the marginal contribution to the variance. And if I want the marginal contribution to the standard deviation, I am taking the derivative of standard deviation with respect to xi. So to do that, I am making a small adjustments. I am multiplying and dividing it by dou variance. That way, I can very well write it as dou variance by dou xi divided by dou variance by dou sp. This is what I am taking to the denominator. So this one is already known. Dou variance by dou xi is something that we already know, which is 2CIP, which we have already computed. And dou variance by dou sp, variance is nothing but standard deviation squared. So 2 times the sp will be the denominator. So 2 cutting off, it comes out like the correlation between the securities returns and the portfolio divided by the standard deviation of the portfolio. So that is what is giving me the marginal contribution to the variance. Now if I have to look at in each of the portfolios, what is the marginal contribution to the variance, I can very well specify, so I can understand which security or which investment is causing very heavily to the overall variance of the portfolio and which sector is not at all contributing anything to the overall variance of the portfolio. So if I look at with respect to P1 first, I am giving the weights of P1 again, giving the covariance, which is the variance covariance matrix, as the input, and based on that I want to find out what is the marginal contribution to the portfolio risk, how each of these 11 sectors are contributing to the overall risk of the portfolio. Here we could see that these are the numbers, but better way of looking at it is let's do the rounding of the same so that the calculations are much better represented. We'll round it to 2 digits after the decimal. So here it is very clear. The first sector, telecom, contributes 0.77% to the overall variance. Some sectors do not contribute at all, right? And a few sectors 16, 18, 62.24 and 2.71. So this is how they are contributing to the overall variance of overall standard deviation of the portfolio when I am looking at it with respect to P1. Whereas when I look at it with respect to P2, this is the contribution: 19 from the first sector, 0 from the second, 6.74, 32, 25. These are the contributions from each of the 11 sectors to the overall variance of the overall standard deviation of the portfolio. And in case of third also, I could clearly see which sectors are contributing more. Even in this case, the real estate in all the cases is coming out to be the zero itself, because there is we did not contribute anything in each of the three cases to the real estate sector as such. So that's how all the three portfolios, what is the way in which they have contributed to the overall risk is something that MRC as a function is going to give me. But the most important thing now is an essential aspect which says if I really want all the sectors to contribute equally to the risk. Now here we have some sectors contributing more to the overall risk of the portfolio, whereas some sectors are contributing lesser to the overall risk of the portfolio. Now I have 11 sectors, right? If I say each sector's contribution should be equal, it's like 1 by 11. So approximately 9.09% should be the typical contribution of each of the sectors to the overall portfolio risk. So if I really want that kind of allocation, that's one more kind of a portfolio that we can think of. So if I have to create a portfolio in such a way that all sectors contribute equally to the overall risk of the portfolio, I can do that using the PERC function, portfolio equally risk contribution. Equal risk contribution to the portfolio is something that I am looking at, and I want to calculate the weights based on that composition. So here we are looking at the standard deviations of the marginal contributions, marginal risk contributions. Each one should contribute to exactly 9.09%. The other way, when I do an MRC of this particular portfolio, based on the weights that I am taking with respect to this portfolio, the marginal contribution to the overall risk should exactly come out as 9.09% for each of the 11 sectors. And that is what this PERC function is going to do for me. Let me try out the code for it. So if you see, I am using P5 as the name of the model. PERC is the name of the function that we are using, which is the portfolio which is equally risk contribution kind of a portfolio. I'm giving the variance covariance matrix, which is the covariance of the index returns, which will compute the variance covariance matrix of the portfolio. That's it. No other. So it should be in the percentage terms. If I set this percentage as false, it will show in case of decimal terms. But if I am saying percentage equal to true, I'll get it in percentage terms. That's the only difference. So when I go with this P5 kind of a portfolio, there are 11 iterations that are performed to get the optimal solution. And if I check out for P5, these are the weights. It's a complete different scenario. Telecom sector has given 8.48 weightage, reality sector 4.07% weightage, and so on. IT requires 13%, healthcare 12%, and FMCG around 17%. So that's how the weights are typically distributed. But now let's see to what extent it is, what is the overall portfolio variance in this case, right? If I look at the weights of P5, right, in the earlier cases we have seen what is the variance in each of the cases. So in this case, let me see the weights of P5. I do a matrix multiplication with the covariance of the index returns to try to understand what is the overall variance. So here the A is coming out to be this much. Then I'll do a summation of A multiplied by the weights of P5 to finally arrive at the total variance of the portfolio. Comes out that the total variance of portfolio is 387,000, and coming out with the square root of the same, which is the standard deviation of the overall portfolio, it's around 622, much higher than the first three methods that we have gone with. So the overall portfolio variance is much higher, but at the same time, if I look at the marginal risk contribution of each of the sectors to the overall portfolio or standard deviation, wherein I give the weights of P5 to this MRC function along with the variance covariance matrix, I see that the contribution, the marginal risk contributions of each of the sectors to the overall portfolio variance is exactly the same. Portfolio standard deviation is exactly the same. So this is what we are calling as the equal risk contribution portfolio, right? So we can have any of these kind of portfolios depending on the requirement, depending on the client's understanding and the client's requirement. We can have any of these kinds of portfolios. The weights would differ across all of them, the risk levels could differ across all of them, but again based on the risk taking capacity and the investment objective of the investor, the appropriate strategy may have to be chosen, right? Now moving on to the next aspect, where we are talking of few more portfolios, right? Very essential thing if I have to look at it in the real world. The four portfolios that we have considered till now, which is the global minimum variance portfolio, most diversified portfolio, or the portfolio where we are talking of minimum tail correlation existing, or even we are talking of equal risk contributions. Compared to all these, the other way of looking at the portfolio optimization is by bringing in drawdown constraints, right? I am exclusively bringing in the drawdown constraint. So as a word, drawdown is nothing but what is the decline, what is the fall in the value of my portfolio, what is the decline in the value of the portfolio during a particular period, right? I am specifying what is the decline in the portfolio during a particular period, whether it is of an investment or a fund or a commodity or any of these things. So what is the amount of decline? How much is typically permitted? So we are talking about the drop in the equity of the account, the value of the account, by what extent I can allow that drop. Those are the drawdown constraints. Normally in the real world, the clients don't want the portfolio value, let's say, to fall less than 90% of the existing profits that you have generated till now. Whatever the loss that you are getting, they don't want the loss to be anything more than 10% of the profits that have already been generated. So those are what are coming out as drawdown constraint. It cannot happen that on one day I have generated a huge profit, the second day again it has turned out into a loss. So they cannot tolerate the losses going beyond a certain point. So those are the constraints that we are setting while building the portfolio. So it may not be the most globally minimum variance portfolio or any of these, but definitely the portfolios focus on the losses not going below a specific point. So we are talking about the average drawdown constraints, wherein I'm looking at different kinds of constraints here with respect to drawdown. One, I can set it as an average drawdown constraint, means the average drawdown value, I'm putting some kind of an upper limit to it. I should not lose beyond a certain point. That is the average drawdown concentration. Or I can have a maximum drawdown constraint. So at any point, the loss cannot cross this particular number. Based on the historical data, I will see if I do the allocation in this particular manner, there is a possibility that my loss could be more than this much. So I should not go with the allocation to that kind of a portfolio at all. One is average. On an average, my loss cannot cross this particular number. That is what we go with average drawdown constraint. Whereas when I'm going with a maximum drawdown constraint, it's a maximum value can't be below this particular number. At any point, the loss cannot exceed this particular limit. That is what comes out in a maximum drawdown constraint. First, let's look at these two constraints, and after that, let me go ahead with the other two types of constraints. So, one, the maximum drawdown constraint, wherein I'm setting the overall drawdown constraint to an upper limit. So if I really first look at the help regarding the same, wherein I am using Pmax DD. Look at this Pmax DD, which is nothing but maximum drawdown constraint for a portfolio. This function returns the results of a long only portfolio optimization, where the portfolio's historic drawdown is constrained to an upper limit. Right? I am constraining the portfolio altogether. Look at this, it requires the price data as the input, not the returns data. It requires the price data as the input. I can set a maximum drawdown constraint of 0.1, saying at any point the portfolio's value cannot lose by 10% of the profits that got generated already. And one more input it is talking of is soft budget. Soft budget is simply saying, can the overall weights be less than 1? Means I don't allocate 100% of the money. I allocate only 50%, 40%, 20%, 90%, whatever, less than 100%. If I'm saying I'm allowing soft budget, which means I am ready to, I'm put a soft constraint that the constraint can be less than 100%. The total weightages could be less than 100%, but when I'm setting it as false, no, the weightage has to be 100% per se. So this is how I give my Pmax DD. So let me take the example out here. I'm taking the Pmax DD, wherein here I'm not giving the returns data, I'm giving the price data out here. The input wise, I'm giving the price data instead of the returns data. So I'm collecting it as a part of P8, Pmax DD, where I'm taking the index as the input, which is index contains the price related data. So I'm taking index as the input, max DD is 0.1 and the soft budget is true. Means I'm allowing per soft budget itself. In some cases, if I don't allow for soft budget, I am setting it as false. There is a possibility that it may not get the optimal allocation at all. Now, if you see here, the optimal allocation it could not get with all 100% allocated sticking to this maximum drawdown. So that's where it's not able to allocate the stuff at all. There is a possibility that if I adjust the maximum drawdown, let's say to 20%, still it could not get the solution. So somewhere I can think of making it as a soft budget instead of a hard budget. So wherein now if I see it has done the allocation, and if I am looking at how much it has allocated so that the maximum drawdown, maximum drop in the value cannot go beyond 0.1. Right? Similarly, I can talk about the maximum drop if I am setting it as, let's say, 100. So it should be in the interval 0 to 1. So this is a pure percentage. So I have to talk about the maximum drop purely in terms of the percentage itself. So if I am setting it 0.1, it should be like a 10% kind of drop. Now based on this, if I am looking at my P8, it says that you invest around 6.96% in healthcare and 12.41% in FMCG. That's it. In all other sectors, don't invest anything. If you really want, at any point your drawdown should not go beyond 10% of the existing value, then you cannot invest anything more. Just invest around 12.41% in FMCG and 6.96% in healthcare. That's it. Right? All other things are not coming into picture at all. Now that's how we are doing the weightage. Only two sectors, right? And if you are typically looking at the structure of this P8, so if you see here, dimension is 120 by 1 kind of a matrix. These are the row names. The column names are the drawdowns. So I can very well get by doing a drawdown time series at the rate drawdown, it's coming out to be a time series. So we are seeing the column name is drawdown. Right? And I could see here these are the format and all the document, these are the weights. So weight wise we have seen that in majority of the sectors it's 0 itself, as we have seen earlier itself. The optimal value is coming out to be this much, but this is the typical solution that is working out, which is the weights across the different sectors. And the maximum drawdown is simply suggesting that only in two sectors I am doing the weights, and in all the other sectors I am simply omitting the stuff. So that's how we are putting a maximum drawdown constraint. If I have a maximum drawdown constraint of 10% for this particular portfolio, this is what is coming out to be my weights. But if I say my maximum drawdown constraint is working out to 20%, right, then my P8 is having a slightly different numbers. It says 13% you invest in healthcare and 24% in FMCG. So that's the kind of suggestion which is more like a double of the existing itself, 13 and 24. But now if I increase the same to a 30% in case of maximum drawdown, it is working out again on the same 20 and 37 are the increases that are coming out. So even if I am going with 50, so probably it is saying if you have a drawdown constraints, focus on only these two sectors. If you have a maximum drawdown constraint in place, focus on these two sectors itself, 34 and 62. But if I am setting it for 60%, now you see. If I am going for 60%, then it has changed the composition altogether. 1% you put in healthcare, 98% you put in FMCG. So if I have a maximum drawdown constraint that is being set, based on that it will do the optimal portfolio. So you are seeing that based on the maximum constraint, it is selecting only healthcare and FMCG, which happen to be the least risky kind of overall portfolios, and those are coming out as the suggestions for the investment. Similarly, I could have the average drawdown constraint as well. So I can very well set the average drawdown should not be more than this much. So by considering that particular option of average drawdown not going more than this much, I can very well select the composition for investment. So if you look at this P6, I am giving P average drawdown. Index is the price values. The average drawdown I am setting it as 10%, but I am setting the soft budget as false. But I can very well set the soft budget as true as well, wherein I can get the overall allocation to be 100%. So where the average drawdown cannot be more than 10%, if I am looking at it is saying you invest everything in FMCG only. 100% of your investment should be in FMCG. Even you set any kind of average drawdown constraint, even if you set it to this, in that case also it's only FMCG. So when I'm going with an average drawdown constraint, it's very much possible that it would select one sector where the possibility of the loss is much lesser. So in this case also you see it's the FMCG sector that is being selected. So the drawdown constraint wise, I may have a completely different, even if I go with the soft budget being true, still it is giving me the 100% allocation to one single sector itself. So that's how we talk about the average drawdown. So which is actually talking about the returns that are coming as well. So we have a constraint in terms of there's a number of sectors that are selected for average drawdown and the maximum drawdown. Then we have a couple of other methods. I'm talking about conditional drawdown at risk. So based on my historical data, I will set that the drawdown, the loss of the value cannot exceed or should be less than some specific value x in 95% of the cases or in 99% of the cases. So I am giving a confidence interval instead of saying in all cases. I am giving a kind of a confidence interval. So in 95% or in 99% of the cases, my loss should be less than, let's say, 10%. So probably in one or two odd cases the loss can increase. So this is what I am calling as the conditional drawdown at risk. So instead of directly saying that in all the cases the loss should be less than 10%, I am giving some kind of cases where in at least 95% or 99% of the cases the loss should be less than 10%. So this is where I am using the conditional drawdown. So the drawdown should be lesser than the upper bound based on whatever is the confidence interval that I am setting. So I could clearly see based on this, I can very well give. So I am giving the index. I am using the function called PCDAR, which is a portfolio where I am taking conditional drawdown at risk. So I am saying at 95% confidence level, I want my losses should be less than 10%. If I am setting the bound as 0.1, so in 95% of the cases, my losses should be less than 10%. Probably in 5%, they can still be more than the 10% of the overall loss. So based on this, if I look at what is the portfolio weight that is coming out, it gives a slightly different solution. So it is saying you put 8% of your money in healthcare and 18% in FMCG. Though it is still choosing only healthcare and FMCG, but you see the percentages are slightly different compared to the maximum. Right, even across, if you go ahead and see, it is doubling from here, 17% in healthcare and 36 in FMCG. So it is doubling from this layer itself, but you see that the weights are slightly higher compared to that of the maximum that you have gone with. The same thing, if you set alpha equal to 100, then it will be equal to the maximum itself. If I am setting alpha equal to 100, so it should be slightly lesser when I am going with dark. Probably if I go with 0.999, which is 99.9%, right? Based on this, if I am trying to look at the percentage, it comes very, very close to what we have got using the maximum itself. So that is what is the relationship that we can bring in between the conditional drawdown at risk and the maximum drawdown constraint. So I can have even those kind, because a lot of customers would be more worried about their losses on a particular period going below a particular specified value. So they don't want the losses to go down below a specific value. So that's like more like a very, very risk averse kind of a behavior. At any point in time, the losses can't go below a specific value, and based on that, I want an optimal portfolio to be suggested to the client. And similarly, one more method that we are looking at in this context is I want the minimum most conditional drawdown at risk. So whatever is the alpha that I am specifying, let's say 95% confidence or 99% confidence, at this particular confidence level, I want the drawdown risk to be as minimum as possible. So I want the portfolio to be designed in that way that given a specific confidence interval, the drawdown risks, the drawdown losses should be as minimum as possible from the historical data. So for that, if I am taking looking at min C dar, which is nothing but I am looking at a portfolio where I want to minimize the drawdown at risk, conditional drawdown at risk, where I am minimizing it at 95 or 99% level of confidence. And it might be possible that I may have to use a soft budget, or in some cases even a hard budget can do the job for me, where 100% allocation can be done to one or more sectors. So let's see how it is working. I'm looking at P portfolio, minimum, conditional, drawdown at risk, P min CDAR. Index is the price data. Alpha is the confidence level. Let's say I'm going with 95% confidence, and the soft budget is being set as false. Right? In that case, I require 100% altogether if it is being set as false. So let's see how it works. When I am looking at P9, yes, this model says if I want the value, if I want the risk should be as minimum as possible, or the drawdown losses should be as minimum as possible at 95% confidence, better you invest 7% in PSU, 34% in the IT sector, 0.79% in the healthcare sector, and 57.45 in the FMCG sector. So that's the kind of allocation that it is giving at 95% confidence level. Provided I am going with a 99% confidence level, again my weightage allocations could change. PSU has gone down quite drastically to 0.93%. IT more or less stable at 33.04%. Healthcare has raised drastically to 20.95%. FMCG has fallen to 38. So basically it's like the allocation is done primarily in three sectors: the FMCG, IT and healthcare, with very minute contributions in the telecom sector and in the PSU sector. Whereas a few sectors completely got ignored based on the alpha value of 99%. So you could see that different portfolios are getting devised based on the different objectives. Some objectives are based on the risk taking levels, and some objectives are based on the drawdown constraints. So understanding the requirements of the clients, appropriate solutions need to be designed, and appropriate portfolios need to be given to the customers. So these are some of the things that I wanted to cover as a part of this session. Uh, we talked very much in elaborate regarding the common portfolios, the diversification measures, marginal contribution to the risk, and even the bringing in the optimization algorithms based on the drawdown constraints. If you have any further queries regarding the same, you can very well get in touch with me by giving me a call on the number that I have given below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.